Hey guys, it's Mike Callahan here from Four Leaf Properties. I've been having a lot of conversations with folks over the last couple of weeks about what should we start to expect with regard to COVID and post-COVID and what's going to happen with our market, what's going to happen with our valuations. And well, I apologize. Got kind of a Bush League presentation for you here today. Don't have our normal video contingent here to give me a hand. I'd like to kind of take you through some data points. I was in the industry back in 2005 during the financial crisis, and it's probably the closest reference point that I have to what might occur going forward. I also got some data points I think are interesting for everyone that we can all learn something from. And probably the most important thing for us to do right now is hunker down, do our homework, know what's coming so we can start preparing. So this graph here basically is a graph of cap rates, historic cap rates over the last, let's call it 15 years. And there's three different lines here. The blue line represents what I'll call low quality properties. It used to be 1 to 2 star properties. The red line represents middle quality, let's call it 3-star properties, and the green line is 4 to 5-star properties. And I assure you there's no agenda here. This is information that we've been collecting for a long time. We collect this from our own experience as well as from industry sources just to be able to track it. But I think you'd find this is relevant and accurate just by any measure. What I think was interesting is back in 2005 to 2010, sort of as we came out of the last financial crisis, went into the last financial crisis, we had this massive expansion of cap rates, right? But the interesting thing was that the low quality properties saw by far the most expansion. They really jumped. In the middle, not so much. And the really high quality properties, they basically kept in a very tight range by and large throughout the financial crisis. And even as we came out and we sort of leveled off, you would have argued that maybe coming out of that financial crisis, you were better off buying low quality properties. You were really, you were highly incented to do so. And that's where the greatest value has been taken out of the market in the last few years. But of course, as you kind of get your way down here to today, and I'll try to zoom in here a little bit, 2020, this is basically where we're indexing again, high quality properties, mid quality, and lower quality properties. And just to give context to this, I mean, we're not talking about coastal California, we're not talking about, rural Kentucky. This is sort of the mid-grade, let's call it the 80% rule by and large. We all know that there's ranges on these things. Okay, so that's where we've been historically. So what are we looking at now? Well, the thing that we think is probably the greatest indicator is unemployment. And no surprise, this is the purple line now in this chart. The rest of these numbers are the same as before. By and large, cap rates have followed the trend of unemployment over the last 15 years. And it isn't perfect, but it's pretty close. And of course, we could look at treasuries, we could look at some other things, but as we look at the data, we think this is probably most representative. And so what we're really kind of do now is trying to figure out how do you handicap where unemployment's going to be. If you listen to the talking heads right now, they're going to tell you that it might go as high as 20 or 30%. Well, we don't think that's necessarily the sustainable level, although we may get to those numbers in the short term. But we think probably listening to all the sort of reasonable folks in the industries, they're saying that probably high single digits is where we're going to be and we could be for a while. So if you're trying to figure out what did cap rates look like at that sort of unemployment range based upon history, we're back to sort of the 2013 and 2014 range. And so let me just hone in on that a little bit. So if you look at 2013 and 2014, where were cap rates? Well, we were somewhere, really close to double digits in the really low quality properties. We were in the very high single digits in the mid quality, and down around, let's say, that 6 cap range for our really high quality assets. We think that's probably where the market's going back to. And while that might seem a little bit shocking, and of course, we sort of demonstrated it here over in 2020, you can actually see where we sort of showed the line if it actually went back to that level. It's probably not unrealistic. I mean, this is a very unusual situation. It's very abrupt. It's definitely going to look like a V, and it probably wouldn't be surprising then that our cap rates also look like a V. Is that sort of reason to panic? No, I don't think it's reason to panic at all. In fact, I think at the end of the day, again, if you know that this is coming, this is just like having, assets in the stock market. You know that the market's going to recover. What do you want to do in the short term? Make sure you've got enough liquidity. Make sure you're taking care of your residents. For folks who bought good assets, I don't think that this is going to be nearly as impactful. If you've got lower quality assets, it's probably a little bit more of a struggle. But then again, we've been there before. This industry has proven extremely resilient over the years, and likely will be again. But we've got to sort of prepare for some tough times here ahead in the short term. But listen, I wish everybody the best. Please stay healthy, stay safe, and look forward to seeing you all at the next MH conference next year. Take care.